Okay, let's define again the three different categories of assets. We had ordinary assets that produces ordinary income and losses when you sell them. There's Section 1231 business assets and capital assets. Okay, so here in this slide we're focusing on the 1231 assets. And we have to hold these business assets for more than a year. If you hold these assets for less than a year, these business assets, they're going to be treated as ordinary assets when you sell them. Okay, so it has to be more than a year. Now, when you have a gain on a sale of 1231 assets, you have to combine or net out the gain with any losses of 1231 assets to get a net 1231 gain or loss. Now, if you have a net 1231 gain after combining all these gains and losses together, the general rule is that the gain will be treated as a capital gain. So we go back to this rule over here. But, and there's always buts, right? Exceptions to tax rules. Part of that gain can be so-called recaptured and turned into ordinary gain. Okay, so there's 1231 gain in the middle of these three different categories. Part of it could be capital gain, or part of it could be ordinary gain. Now, if you have a loss, not a gain, but a loss of a net 1231 combinations of gains and losses, the loss will be treated as an ordinary loss. And that's good. We don't want losses, but if you do have a loss, you want it to be an ordinary loss that you can deduct the whole thing at one time. And there's no dollar limitation or no carryover. You just deduct the whole thing. And if you have a gain, you want that gain to be a capital gain taxed at the lower rates and not treated, or so-called recaptured, and treated as an ordinary gain taxed at the higher regular tax rates. Boy, this slide looks like a mess. Here we say that recapture applies when we have depreciation taken in prior years. Okay, so the amount of that 1231 gain will turn into ordinary gain. We call that recapturing that depreciation to the extent we took depreciation or should have taken depreciation. Here it says depreciation recapture rules are designed to transform, that's another word for recapture, some or all of the 1231 gain into ordinary gain. So you look at that 1231 gain, and the maximum amount that will turn into ordinary gain is this amount here. Even though you may have taken lots of depreciation, more than the gain, more depreciation past years than the gain you're now recognizing upon the sale of the asset. Okay, so again, Section 1231 gain will be turned into, we call this recapture, into ordinary income to the extent of any depreciation you took in past years. And if you have extra gain after this recapture, that gain will be treated as a long-term capital gain taxed at that lower rates, yeah, those preferential rates. Remember that 0% or the 15%, which is nice. Net 1231 gains receive preferential tax treatment. Again, either the 0% or the 15%. But that's only after you've recaptured what you need to turn into ordinary income. Here, net 1231 losses are treated as ordinary losses. So you get to deduct the whole thing. Now, if you had a capital loss, which we don't have when you have 1231 losses, never, the capital loss would be deductible up to $3,000 per year against other ordinary income. And if you have extra capital losses, then that has to be carried over next year to offset your future capital gains. Now there's different types of depreciation recapture. One type is called Section 1245, and this applies to personal type business assets. Personal meaning non-real estate, like an automobile or a computer. Okay. And this applies to all of the depreciation taken on this type of asset in past years. So again, here's our 1231 gain, and you're going to recapture to the extent of depreciation called Section 1245. This is again non-real estate. We use the word, let me spell this out first, real estate. This, we use the term, instead of non-real estate, we use the word personal property. But it has to be used in a business. So this is going to turn it into ordinary income. Now we'll see in next slide, which is not too clear. We'll see it clearer in a exercise. There's a Section 1250 recapture, and this applies to real estate depreciation. And again, you're turning this into ordinary income. But it's not all the depreciation in the real property. It's only depreciation to the extent it exceeds straight line depreciation. Okay, so that's ordinary income tax at ordinary rates. Now, if you have depreciation on this real estate that's not recaptured into ordinary, we have something called recaptured Section 1250 depreciation. So this amount of gain is going to be taxed at a special 25 maximum % rate. Okay, this recaptured depreciation is taxed at regular rates, but this only applies to the extent the depreciation you took over the years exceeded the straight line method of depreciation. And the thing is, most current real estate is only depreciated at straight line. It's the older assets, maybe bought back in the 80s, maybe even 70s, that were depreciated faster than straight line, and the excess over the straight line would be ordinary. And then any extra depreciation you took, called unrecaptured Section 1250, is going to be taxed at a maximum rate of 25%. This ordinary recaptured income, this ordinary recaptured gain, is taxed at the regular high rates of the taxpayer. Section 1250 applies to depreciation on buildings, okay, on real estate improvements. And of course, you don't depreciate land, so any gain upon the sale of land, there's nothing to recapture there. Here, the amount of capital gain attributable to depreciation taken previously taken is taxed at that 25% rate. And we call this again unrecaptured. If you do recapture the depreciation for real estate, that's taxed at regular rates. If you don't recapture the gain on real estate, that's called unrecaptured, and again the maximum rate is 25%. And if you have any gain remaining after that, let's go back to the previous slide. So here you're selling real estate, so you recapture the Section 1250 gain in excess of a straight line, and here any extra gain to the extent of depreciation you took is taxed at 25%. And then anything else over that, this is land now, all of this is real estate. I shouldn't call it 1250. 1250 is these two, but any real estate gain in excess of any depreciation here is taxed at the capital gain rates, long-term capital gain. And that's what this last bullet is saying here. Question number 1. Under Section 1231, gains receive preferential tax rate treatment, but losses are limited to $3,000 per year. Well, definitely this last phrase here is wrong. When you have a Section 1231 business asset sold at a loss, the loss is treated as an ordinary loss. This limitation of $3,000 per year is talking about a capital loss. Capital, I was going to say capital gain loss, but a capital loss. Okay, and also this first part here, the gain will receive preferential tax treatment if you don't have to recapture any of that gain under Section 1245 and 1250. So this should be a false statement. And number 2, the only pure, that word is not too clear here, pure Section 1231 asset is land used in a trade or business. Here the answer says true. And technically, when you have land, there is no depreciation on that part of the property. You cannot depreciate land. So there shouldn't be any recapture of the gain applicable to the land. So all of that gain on the sale of the land portion will be taxed at that capital gains rate and not recaptured to ordinary income. Number 3, what is meant by the term depreciation recapture? Well, what you're doing is first calculating the gain on the sale of your business asset, and then to the extent you took depreciation on this property you just sold, you're going to turn that gain into ordinary income. And again, there's 2 types of recapture. One is Section 1245 on personal business assets, and the other is called Section 1250, and that's on real estate, but only to the extent the depreciation taken is larger than straight line depreciation. And then any extra depreciation you took, called unrecaptured Section 1250, is taxed at a 25% rate. And then if you have gain beyond any depreciation on real estate, then that's taxed at the capital gain rate. In this case also, in the case of business property, once you recapture this depreciation, any excess will be also capital gain. Number 4, what is the difference between 1245 assets and 1250? Well, the 1245 is personal, non-real estate, and the 1250 is real estate. And the rules are slightly different for these two. In the case of personal business property, you recapture all the depreciation to the extent of any gain. In the case of real estate depreciation, it's only to the extent it exceeds the straight line, and then any extra depreciation up to the amount of that gain is taxed at 25%. Number 5, what is the difference between recapture and unrecaptured gain? Well, here we're implying just real estate now, and recaptured is again to the extent it exceeds a straight line, and then any extra depreciation is called unrecaptured, taxed at 25%. Special types of sales. So when you invest in stock, you may be buying lots of shares in the same company, but when you buy them, they may be bought at different dates and different prices. So you may have some short-term and some long-term, some at less expensive, some at more higher prices. And when you sell your stock, you can instruct the broker to sell the old ones or the new ones, or the high costing ones or the low costing ones. We call that specific identification method, but it takes a lot of record keeping, and your broker probably doesn't like that. They just want to sell whatever is available. And typically, if you don't track the the lots or the blocks of stock, then you have to use a method of costing called the first in, first out method, where you always assume to sell the oldest item you have of that company's stock. Now, mutual funds is probably the main way most non-professional investors want to invest with. Versus buying shares of stock, we have to keep track of the company. One of the rules about investing is to diversify, to buy into lots of different companies in different industries. So if one company goes bad, you don't lose all your money. So typically, let's say this is the investor here. And what they do, instead of buying into lots of different companies, they buy into a few mutual funds. Or really now the type of investment is called an exchange traded fund, which almost works like a mutual fund. And this mutual fund or exchange traded fund will buy stocks into lots of different corporations. Could be dozens or couple dozens of companies. So when you buy a share of this mutual fund, you really are buying into lots of different companies. And typically, when these stocks here rise in value or decrease in value, that affects your investment in the mutual fund going up or down. Also, these corporations would possibly pay dividends to the mutual fund. And in turn, the mutual fund by law has to distribute that dividends to the investors in the mutual fund. And you pay taxes on these dividends. Remember last semester we learned about the 1099 DIV form. Well, instead of taking the money as a distribution, what the investor would typically say is to the mutual fund company to keep that dividend and buy some more shares for you of that mutual fund or exchange traded fund. Now, even though the money is not actually distributed and purchasing more dividends, this dividend, this amount of money being reinvested, is still taxable, reportable on that 1099 DIV. But now you're buying more shares of the mutual fund at different costs. So again, you got to keep track of that original investment you paid for buying that mutual fund, plus the reinvested dividends at different costs than that initial investment. So it gets really complicated in terms of when you have a mutual fund that's growing in the number of shares because of this dividend reinvestment. And when you eventually sell or redeem your mutual fund shares with the mutual fund company, you have to figure out that gain or loss. So here it says there's 3 different methods of figuring out the cost for that mutual fund. Now, we just talked about this first in, first out when you own shares of stock in a company. But again, this is not an individual corporation. It's a mutual fund that invests in lots of different companies. So the mutual fund will probably help the investor keep track of the cost of the shares of mutual funds, but they're going to automatically use this average basis method, where it averages out all of the cost into the average cost of one share of mutual fund, which is probably what most people should do. And the broker would give you a sales price and the average cost and the gain based on that average cost whenever you do redeem your shares. We talked about that 1099 form DIV to show the amount of dividend income you have to report. Whenever you sell stocks or mutual funds, the mutual fund company or the broker is also going to issue out, maybe on the same piece of paper, a 1099-B for broker, showing the amount of gross sales price you had collected on the sale. And hopefully the broker or the mutual fund company will show you the costs that you can deduct on your tax returns and the ultimate gain or loss you need to report. So let's say that you have some stocks or mutual funds and they're totally worthless. You didn't sell them to document how much you got because it's zero. You cannot sell them. So what we have here is something called a worthless security. So what you can do, in the year the security becomes worthless, you can report that loss of that security on your tax return. But it has to be totally worthless on the last day of that year. So how do you know it's totally worthless? Well, if you know you can't collect anything at the end of the year, then you can probably write off, deduct as a loss, the cost of that investment. Here it says just because a company declares bankruptcy doesn't mean that the security is totally worthless. There's still a possibility investors can get something back. So if you know it may be worth something but you don't know how much, you cannot deduct anything. It's only when you finalize that you do collect something and get that money that you can report the loss. And if you know for sure that it's worth nothing, you're going to get nothing. At the end of that year, you determine it's worth nothing, worthless. That's the year to claim the loss.